Hey, welcome to the podcast, everybody. Thank you for joining me. It's going to be kind of a brief one, if I can. Seems like I always say it's going to be a brief one and then end up going the usual 15, 20, 25 minutes, whatever it is. But do have plans this evening. It's my wife's 40th birthday tomorrow, so Mrs. E is 40. Happy birthday, Mrs. E. I'm already 40, so, you know, I'm looking forward to the 50. Well, I'm not that old, but 50 will be here in a few years. But thank you for joining me. And the stock market, as you can see, kind of a mediocre day. We've had some of those lately, kind of just back and forth a little indecision. The market trying to digest all these different things going on. And today, you know, it's just, I guess it feels like the stock market feels a little tired. And we had some few things today. We had this Hills and Rath update. He's the Wall Street Journal reporter, and talking about tapering and would they do less and would they not do it, and all these different things. And it's ridiculous that everybody trades on this constantly, but that's what the market, that's what investors are doing. They're trading on this, and it affects your investments and my investments. So you had some of that. You had a little rally in treasuries at the end of the day. The stock market rallied a bit into the close, but still looks a little tired. Of course, we had this SAC Capital indictment. This is the big hedge fund, very successful hedge fund, Stephen Cohen. And, you know, a lot of people on Wall Street are fearful right now that liquidations from that hedge fund could spark a sell-off across the board, because it's going to have this domino effect. When they request their money back, the investors, SAC has to sell positions. They own a lot of positions in a lot of different things, and it would trickle down. And of course, you know, there's the indictment talks about them knowing information before, you know, earnings and all those types of things, and just making these trades in advance of some of these reports and profiting from it. So we'll see how that shakes out. But that was some of the news today. We also got a durable goods report, which looked on the surface much better than expected. But of course, after the digging in the numbers, it was a lot of basically Boeing and a lot of transportation in there. So, which is still good. It's not that transportation's not part of the economy. It's just it was a kind of a lopsided report where you have a big piece of it attributable to one company and one specific sector. We had a lot of earnings after the bell. Amazon reported, and you know, it seems like if you take a look at Amazon, it seems like it doesn't matter what they report, what their margins are doing, any of that. The stock seems to sell off a little bit, sometimes for a day or two, and then just go up. And their PE ratio is like infinity, I think, right now. It's probably the most difficult company to analyze. And so people buy it, I believe, for the brand and kind of the domination of what they do, because they do dominate. They're an easy company for retailers to use. I love it. I think it's great, but very difficult for a company like that to for you to buy a company like that. But it appears, you know, after the bell that they are, you know, flat to up a little bit, and we'll see if it can keep going over 300. The other big one was Starbucks, and in our aggressive strategies, we did purchase a little Starbucks today before the close. You know, if you look at the Starbucks chart, this is a company I've been wanting to buy, and you rarely have had dips. And, you know, you get these moves up, kind of a move sideways, move up, pull back, move up, pull back, move up. We had the pullback right to the 50-day moving average. You had to think by looking at some other companies. Dunkin' Donuts had reported, obviously not really a competitor, but kind of in the same space. They reported, and so you got kind of an indication maybe what would happen. And so we bought about 2/3 of our position in advance of the report. And after the bell, it was up about 2.5% during the day. We kind of averaged into it all day. After the bell, it's up to about $71, $72. So a nice day overall in the day, up about 7%. But to me, this isn't really a trading stock. It's more a function of the fundamentals are good. It's not a cheap stock. This isn't a value play by any stretch of the imagination, but there is a premium that some of these stocks get, just like Amazon. I think Starbucks gets that same premium. So right now it's trading somewhere up in this range, so that would be a little bounce off the 50, so a successful bounce. But other than that, not making a lot of moves right now. I did put on a short position today on the S&P 500 using SH. And again, this was for my aggressive strategy just to hedge against the stock market pulling back a bit. This is not a net short position. It's almost a pairs trade where you got something where I own Starbucks on one side of the ledger. It's having a really good day, and then you have SH on the other side just to balance that out. So if you can get the market going down and you get some outperformance from your stocks, that's great. But what you're seeing right now is, I think the stock market is, you've had these little runs, and it appears like things are rolling over here to where we could get a little move up. So this would be a shorter term trade, kind of an insurance policy. And if you're asking kind of what would make me sell that, it would probably be a move up above the recent highs. And that's not a big, that's a tight stop. But if we break out to new highs, we're probably going higher, because it's right now everything is lining up for the stock market to roll over just for a minor pullback. But again, shorting the market right now, I would tell you, it's kind of playing with fire, because we haven't had big pullbacks. If we had a pullback like this, which is about 6%, that would surprise me in this time. I think we get a pullback maybe to the 50-day moving average, and if we got one to the 100, that would be not as big a pullback as the one before. But I could see some of those scenarios playing out, and then we would bounce. But again, that's where I would be taking profits. So this is not a long-term Karl's turning bearish position at all. This is for my aggressive strategy. It's to hedge against some stocks that could fall if the market rolls over temporarily. So it's just an insurance policy. But again, I think in the big picture, I hope I'm wrong, because I got a tight stop on it. And but overall, the market just looks a little tired right now. Some of these earnings have been very mixed. Obviously, the revenue's been mixed. Some of the economic data coming out's been mixed. So it wouldn't surprise me to see this thing pull back a little bit. A couple of you guys have pointed out the volatility index is at a level where we have seen, obviously, some spikes before, which means a spike in the volatility here, 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 and could we be going up, something like that. But, we're at these low levels right in here, and every time we've done that, the stock market has had a pullback. And it could have been 2 or 3%. I'm not looking for anything major, but I just think it could be a nice trade for a short. But again, you got to be quick with it. You got to watch it. It's not a time to go out of town for 2 weeks and throw your short position on. I would not use the leveraged ETFs at all, because again, we've talked about the problem with those is that with something like SH, you could hold for a while. With a double or a triple inverse ETF, you lose that correlation over time. So with those, I would not be using them for this particular trade. I would rather put this on. Again, it's almost a pairs trade where you're short the market but long a lot of stocks that you obviously think are better than the market, which is why you own them. Let's take a look at gold real quick. Still, I don't think the trade's over in gold. It's at a real critical place here. We've been throwing some blogs up lately showing some key levels. And on GLD, it kind of turned around at the 50-day moving average, which is the blue line, and this is the resistance it's running into right here. So it would make sense that it would pull back, but I'll tell you, this little trend that it's been in here, it's still in that. So this gold could surprise some people and keep going up, and if it does break through the 130 level, then I think you're obviously looking at, let's call it 142, somewhere in there, which would be right up in here. And then it could spend some time in here. So watch gold. It's at a real critical area, I think, right now. And not a lot of volume on GLD either. A lot of those gold stocks were up this morning, and gold was up most of the day as well, and got stronger, and then it got a little weaker. But overall, GLD finished up about 90 basis points, or 0.9% on the day. Now, the good old-fashioned stock market, as we talked about earlier with the short, we're just hanging on to this old trend here. But again, I think the main thing for longer term people is to look at the 50-day moving average, the 100-day, the 200-day. They're all pointing up. They're all going in the right direction. So it's a matter of how cute do you want to get. I'm simply wanting to buy more on dips, and I think right now, there's not intensity on these sell-offs, but it could float down a little bit. But I'm wanting to buy dips. I'm just saying, hey, with some extra cash that I have right now, why not, on an aggressive strategy, why not short the market and see if it does come back a little bit. And if it does, great. If it doesn't, it goes back up to new highs. Then we get stopped out for a very tight, 1 or 2% loss, something like that, and move on. Want to draw your attention to interest rates very quickly, and we'll wrap it up with that. Interest rates could be forming an head and shoulders here. See if you can follow that. Something's wrong with this guy's shoulder. Let me draw it another way. But basically what you're seeing is you're having the left shoulder here. It went up and went to new highs, came back down. Can it continue up, or are we going to roll over here and head back down? Interest rates were up a little higher today, and they came back in. So we'll see. That's a pattern that is going to be very interesting to watch. So you're looking at this, and this is the right shoulder. So again, the formation here would be that this rolls over and starts to head back down. Is it down here or here? I don't know, but it would be potentially lower rates. And so we need to watch that. Obviously, a move higher means, hey, investors are thinking that there's going to be more tapering. They're thinking that they're going to, the economy is going to be much better, and it's going to justify higher interest rates. And I don't see it from an economic standpoint. I think America is doing better than a lot of places on a relative basis. But overall, again, as I've said numerous times, I don't know how high interest rates can go in this economy. You're already seeing the effects of just this little move here from 1.6 to 2.6. You're seeing that move affect the housing market and the housing stocks. Already you're seeing that. And then we've talked about oil being at 108, and it could come back a little bit, but still, that's higher. You've seen a lot of metals prices and some of the materials prices go up after those China comments the other day. So all those things are going to be, I think, a damper on the consumer. And I don't see how the economy can continue to accelerate in light of that. Again, as an American, as somebody who is hoping for a good economy, I hope I'm wrong, but I don't think we're going to get that. So rates could go higher. It's just can stay on this trajectory and continue higher? I don't think so. All right, thank you for joining me. Appreciate it. Don't forget to check out all the blogs, podcasts, Twitter, all that type of stuff, and we will check back with you hopefully tomorrow. Take care.